Warren Hogan, economic advisor at Judo Bank. Warren, did the RBA make the right call today with that 0.25% increase?
Yeah, hi Kieran. I think they did. I didn't think they have much of a choice. They changed their approach at the last meeting to 25-point hikes, and I think they would have risked some embarrassment if they switched back. They would have had a view that they sort of didn't know what they were doing. They've got a strategy, and that is that they want to get the cash rate up to around 3.25, 3.5, in line with the budget forecasts, and hope that does the job. And that means going at 25 bips from here on in. As you've been talking about, monetary policy operates with a lag, and they're yet to really see the effects of what they've done already on the economy. So I think they'll be patient until the new year, and then we should expect another 25 in December, and probably even one or two early next year. And then it's all becomes about whether or not the inflation starts to recede, whether they've got to go beyond that.
And going to that lag question, it does have a lag effect because it takes banks months for it to be passed on, but also for those Australians, tens of thousands who are on fixed mortgages at this point. But that's going to change early next year as well.
Yeah, there's a number of things that are going on that creates that lagged response in the economy, and you've noted all of them. And it makes it really difficult for them because, we've got rates still very low by our historical standard, and what I mean compared to the last 20 or 30 years. They're high compared to where they've been in the last 10 years. And what worries me is that because we've got the highest inflation in 40 years and still an economy that's solid, and they noted in the statement today, it's still growing at a healthy rate. Unemployment's at 50-year lows. Wages are rising. What worries me is that when we wait and see next year and come back from our holidays, that the economy's still strong. The economy's resilient to this, and that we actually end up having to have rates at 4 or higher to really get rid of this inflation risk. And so that's really the problem. We will get some impact mid next year from people rolling off fixed mortgages, but I wouldn't overstate that. We've seen and heard a lot about cliffs in the past, fiscal cliffs. When people expect things to happen, they tend not to happen. They get ready for it. So we should give them the credit on that front. But yeah, we're going to get a lot more information come the new year on how the economy is responding to this. But so far, it doesn't seem to be responding in a big way.
We have seen some further data today on the day of the rate rise showing property prices down for 6 straight months. Is that not indicating that things are cooling somewhat?
It is, and it's certainly indicating that those really low levels of interest rates, and now that they've been removed, were responsible for the silly prices we saw in many Australian cities and even regional areas through the pandemic or through the last 12 months. And what's sort of I'm looking at is the fact that we've seen Sydney prices fall 10% now from the peak earlier in the year, and the market's hasn't even got a whiff of panic. People are still buying and selling houses. They're just sort of doing it at a lower price level. And that actually talks to resilience, that people have got jobs, people are still optimistic about the long term, which they should be. And that tells me the RBA is not getting the traction they need. So we've got no evidence that these lower house prices are A, causing people to have to sell in any significant way, or B, that it's forcing them to change their spending habits. And those are the two things you need to see for interest rates to be having the desired effect to slow the economy down. And it has to slow the economy down. There's no two ways about it. It's not actually about raising rates. It's about slowing the economy down to reduce the excess demand in the economy and that inflation that we're seeing there. So it's a tricky situation, and I fear we've still got a fair way to go on this rates rising cycle.
So we'll be talking about it into next year. Finally, you heard the Treasurer saying how important it was for him to be in lockstep, essentially, with the monetary policy, not to be at cross purposes. In hindsight, as we look back on his first budget, was it the right approach? It was certainly nothing like we saw in the UK just a couple of weeks ago.
Yeah, well, the UK was madness, and we've seen what the result of that was. I mean, here in Australia, we're applauding the government for not being irresponsible, that is, not spending the windfalls that they received in an overheating economy, which I think is a fairly sad indictment of the state of the conversation. The reality is that if this inflation proves to be much harder to get ourselves rid of than we currently think, then I think that they'll look back in the budget as a missed opportunity to tighten up. They're not hampering the economy with fiscal policy. They're not actually helping the RBA fight inflation. They're not making it worse. Now that's fine. I think let the RBA do the job. But if it does prove to be worse and much more stubborn, then I think a bit of tightening this year probably would have helped. And that's the risk they're now running, because, of course, before the next election is when all this will come to a head. If indeed we do get an overheating economy, very high rates, and a recession in the end, like the late 1980s, or even what we saw before the financial crisis.
It's a precarious situation as we come to a close in 2022. Warren Hogan, Economic Advisor at Judo Bank, I'll let you go. Thank you so much for your time and your insights as always. I appreciate it.
Fantastic. Thanks, Kieran.